Today I'm meeting you with the second part of the depreciation concept. In my first earlier video, I have given you a better understanding about the concept of depreciation, which is new to you. And in this video, the second part of it, I am trying to basically focus your attention towards the accounting for depreciation. So, as you all know, since a significant portion of cost is unrecoverable from the scrap value at the time of selling an asset, the accounting of depreciation is needed by the business organizations actually to show a true profit. So, the amount of depreciation is considered as an expense in financial statements and will be cut off or set off against the profit. So, actually, this loss of depreciation is considered as an expense in accounting, and when you are recording them in the financial statements, when you are arriving at the profit, the amount of depreciation will be deducted from the profit of the business. So, thereby, we will be debiting the relevant amount of depreciation under the expenses. So this set aside amount or cut off amount as an expense will be accumulating in the business through its economic useful lifetime. As you know, the amount that is considered as an expense will be debited in the relevant depreciation account, and the amount that we are going to credit, which I which I'm going to explain in my next part, the credit amount will be accumulated in an accumulated depreciation account, and it's like a reserve, and this will be credited to the accumulated depreciation account over a period of time. Actually, it is the useful lifetime of an non-current asset. So thereby a business is able to replace or purchase a new asset at the end of useful lifetime of the previous asset or the old asset or the existing asset. So thereby the relevant journal entry will be relevant depreciation account debit and the accumulated depreciation account credit. I like to explain this to you through an example in order to give you a clear cut idea about this. So before that, let's see why are we debiting the relevant depreciation account. As I told you earlier, we will be treating this amount of depreciation, the annual amount of depreciation, which we have been calculated based on the straight line method or the reducing balance method, from the accounting period, from the relevant account, from the financial statements during the relevant accounting period as an expense. So thereby, as you all know, all the expense accounts are debit balances. So in order to make it, in order to show it as an expense, so we will be opening up a new account called relevant depreciation account, and the amount which you have calculated based on the straight line method or the reducing balance method will be debited to the relevant depreciation account. Here relevant in the sense, if it's a building, if the asset that we are considering is a building, we will be opening up a new account called building depreciation account. Or if it's a motor vehicle, we will be opening up a new account called motor vehicle depreciation account. If it's furniture, we will be debiting furniture depreciation account. Likewise, based on the asset that we are going to depreciate, we will be opening up relevant depreciation accounts. So then, since it's an expense, since the accounting point of view, we are treating it as an expense, we will be debiting the relevant account. So the accumulated depreciation account will be credited. Why are we crediting the accumulated depreciation account? Is it's like a reserve. Every year we are setting aside, every accounting period we will be setting aside the relevant amount which we have calculated based on different criterias, and we will be accumulating it in order to replace a new asset at the end of the useful lifetime of the existing asset. Okay, so here the accumulated depreciation account, here if the asset that we are considering under depreciation is motor vehicle, motor vehicle depreciation account will be debited and accumulated motor vehicle depreciation account will be credited. So the two accounts that you are going to open must be related to each other. Relevant build, if it is buildings, building depreciation account debit, accumulated building depreciation account credit. If it's equipment, equipment depreciation account debit, accumulated equipment depreciation account credit. Like that, we will be uh, cre- uh, keeping the double entry or the journal entry. So here, in order to give you a proper idea, I have quoted an example. It says the accounting period of Sadev's business ends on 31st December 2019. The non-current assets of a business are depreciated using the straight line method annually at 10%, and the business maintains an accumulated depreciation account. So in this business, in Sadev's business, the business ends at 31st December 2019. Thereby, this is the last date of the accounting period. So when you calculate 12 months backwards, 1st of January 2019 will be the beginning of the accounting period. So from 1st of January 2019 to 31st December 2019 will be the 12 months or the relevant accounting period for this adjustment. So therefore, they are telling that they have said that the depreciated the assets, all the non-current assets will be depreciated using the straight line method, and the annual depreciation rate they have given, they said it's 10%. And they also said that the business maintains an accumulated depreciation account. So therefore, the cost of non-current assets which were purchased on 1st January 2019 are given below. Actually, these are the values of the non-current assets in the business. They are the motor vehicles of 700,000 and machinery worth of 300,000 rupees. At the beginning of the period, the non-current assets have been purchased at the first date itself of the business. So thereby, these non-current assets, the motor vehicles and the machinery, will be there in the business throughout the accounting period, which will starts from 1st of January 2019 to 31st December 2019. So therefore, we have to calculate 10% of depreciation from both the assets. So thereby, 700,000 into 10% will give you 70,000, and that 70,000 will be the relevant amount of depreciation for the accounting period starting from 1st January 2019 to 31st December 2019, and again from the 300,000, when you calculate 10%, it will give you 30,000, which is the annual machinery depreciation amount, which we are going to treat under the financial statements. So then when you write the two journal entries relevant for the earlier example will be like this. In the general journal, we will be recording for the motor vehicle of 700 with the for the motor vehicle cost of 700,000 rupees on 31st December 2019. Motor vehicle depreciation account debit 70,000 and accumulated depreciation for motor vehicle account credit 70,000. So thereby the narration will be accounting for motor vehicle depreciation at 10% under the straight line method, or you can write it as method at cost. Accounting for motor vehicle depreciation at 10% under the straight line method at cost. But here the motor vehicle depreciation account 70,000 will be debited, accumulated depreciation for motor vehicle credited. Then when it comes to the machinery, when you calculate 10% based on the cost of the machine, machinery depreciation account will be debited 30,000 and accumulated depreciation for machinery will be credited 30,000. And the narration will be accounting for machinery depreciation at 10% on cost, or you can give any narration which is relevant for this. Then after recording, the first step will be, according to your knowledge, the first step of accounting will be recording the transactions in relevant prime entry books. So for the all types of adjustments that we have learned, the relevant prime entry book will be the general journal. So here the depreciation adjustment also will be done in the general journal as I have shown to you, and thereby the next step will be recording them in the ledger accounts. So thereby we have to open up 4 relevant ledger accounts. One is motor vehicle depreciation account, and the other account will be the accumulated depreciation for motor vehicles. Then when it comes to the machinery depreciation account and accumulated depreciation for machinery account, like that 4 accounts we had to open up. So then the double entry goes like this. In the motor vehicle account, motor vehicle depreciation account on 31st December 2019 will be debited 70,000, and at the same date in the motor vehicle, I mean, accumulated depreciation for motor vehicle account will be crediting the 70,000. So this is how the double entry goes. Debit the relevant depreciation account and credit the accumulated depreciation account. Then when it comes to machinery also, on 31st December 2019, the debit entry will be in the machinery depreciation account, 30,000 will be debited, and the credit entry will be credited into the accumulated depreciation for machinery account as 30,000. So finally, this once you balance the account, this 70,000 will be transferred to the profit or loss account. So here the relevant depreciation account credit and the profit or loss account will be debited. Why? Because it's an expense and we have to deduct it from the profit, or we have to set off it against the profit in order to arrive at the true profit of the business. So thereby we will be crediting the motor vehicle depreciation account and debiting the profit or loss account. Then the same treatment will be done under machinery depreciation account too. uh, Machinery depreciation account will be credited and profit or loss account will be debited under the relevant expense. So then what are we going to do, or what is the treatment for the two accumulated depreciation accounts? The balance, once you balance the account, the balance will be carried down and it will be carried forward to the statement of financial position. Here also, once you balance the account, this 30,000 carried will be carried forward to the statement of financial position. So let's see in my next clips how we are going to show this in the statement of financial position. Now, actually, in this business, the this is the first year that they purchase the assets, and this is the first year that, therefore this is the first year that they are going to account for depreciation, the relevant assets at the cost of them. So therefore, once you open up the accumulated depreciation accounts, there can't be any brought forward balance from previous years in both accumulated depreciation for motor vehicle account and accumulated depreciation for machinery account. There can't be any brought forward balances as at the credit side as opening balances. Why? Because this is the first year that they are going to calculate depreciation. This is the first year of their operations. So then there can't be any opening balances, and based on the cost of the two assets, we are going to calculate for depreciation for the present year. But in most of the cases, there can be a depreciation or depreciation which they have been calculated for the previous years, and thereby there can be accumulated depreciation brought forward values at the beginning of the period before we are going to treat for depreciation during the relevant accounting period. Okay, so this is the way that we are going to present the non-current assets in the statement of financial position. In as if you can remember, when we were studying the two formats of the profit or loss statement and the statement of financial position, basically in the statement of financial position, we had only two lines, but I ask you to maintain three columns there as well. This is the time that we are going to use the third column, which we have been learned already. So there we will be name them like this. Non-current assets is the type of assets, and first column will be the cost in rupees. Then the second column will be named as accumulated depreciation in rupees. Thereby, the difference between the cost and the accumulated depreciation value or the amount will be known as carrying amounts. Carrying amounts. Another name is net book value. Net book value. So the now in this example they have given buildings and motor vehicles. So if we apply this to the example that I have got here, we have motor vehicles and machinery. So here you have to write motor vehicles and machinery. Then the cost will be 700,000 and 300,000. And the accumulated depreciation, since this is the first year, as I told you, here the value will be 70,000. The motor vehicle value will be 70,000 and the machinery value will be 30,000. So thereby, when you deduct 700,000 from 70,000, 700,000 from 700,000 from 70,000, 630,000 will be the carrying amount of motor vehicles. When it comes to the machinery, cost will be 300,000, accumulated depreciation will be 30,000, and thereby 270,000 will be the carrying amount. So likewise, the difference between the cost and the amount that we have been depreciated so far will give you the carrying amount. Or then when you, according to the accounting standards, it's a must. When we are preparing the two state financial statements, we have to do it in a comparative manner. So thereby, the accounting, the law of accounts or the accounting standards have given instructions to show it in this manner, and the costs of the two or whatever the number of assets, non-current assets, must be totaled here, one under the other, and the total accumulated depreciation values must be totaled and shown here, and you have to double underline it and show it in the financial statements once you are presenting the financial statements. These carrying values also must be total, and we have to leave it here, and you have to add it with the other uh, types of assets, like current assets are under this. So with that you have to add and you have to get the total value of assets. Therefore, we are not going to double underline the carrying amount column, but the cost column and the cumulative depreciation column, you have to double underline and finish it off. So it shows at the end of the accounting period, the business owns this much of non-current assets, and they have been depreciated. The total depreciation that they have been done so far is this much, and thereby the carrying amount will be this much of the business. Okay. Then, in this example, I want you to show you the way that we are going to calculate depreciation for for assets, for non-current assets, which they have been depreciated over the previous years as well. So this is not the first year that we are going to calculate depreciation for the non-current assets. So thereby, as I told you earlier, already in the accumulated depreciation accounts, there will be values which are brought forward from the previous years. Okay, let's see. The accounting period of Nasar's business ends on 31st December 2019. The non-current asset the business had as at 31st December 2019 are as follows. Actually, these are the non-current assets of Nasar's business. So it has been, these are the year-end balances as at 31st December. So that also started on 1st of January 2019. So then we are going to accounting for the 12 months period or the accounting period. So accumulated depreciation On 1st of January 2019, I mean at the beginning of this accounting period, these are the values which they have been already brought forward from the previous years for what they have been depreciated. So the non-current assets, there are four non-current assets: buildings, motor vehicles, machinery and furniture. The cost of each will be: buildings 800,000 rupees, motor vehicles 700,000 rupees, machinery 100,000 rupees, and furniture 250,000 rupees. So they have been depreciated over the previous years, and the accumulated depreciation for buildings will be 200,000, and the motor vehicles 140,000, machinery 20,000, and furniture 50,000. So then these values will be shown in the relevant accumulated depreciation accounts as a brought forward value in this place and this place and the like that for the other assets as well. So the brought forward values must be credited under each accumulated depreciation account before we are going to treat for the adjustment of depreciation for the relevant period. In this case, for the counting period of 1st of January 2019 to 31st December 2019. Okay. Further, the sum says the non-current assets are depreciated cost by 10% per annum, and to record the depreciation, an accumulated depreciation account is maintained. So then it is very clear to you. So thereby, this is the way that the depreciation will be calculated for the relevant accounting period as an expense. Okay, let's see from the beginning. The depreciation included in the profit or loss statement as an expense relevant for the accounting period is as follows. Building depreciation from the cost, you have to calculate 10%, and thereby the amount which is relevant for the period will be 80,000. Motor vehicle, which is worth of 700,000, also um, calculated 10% out of the cost, and it will be 70,000. Machinery, 10%, it's 10,000. Furniture at cost, 10% will give you 25,000. So like that, these are the relevant depreciation amounts or the values for this or the current accounting period. So then the accumulated depreciation relating to the assets as at 31st December 2019 is as follows. Okay. Now, according to this sum, we have to open up 8 relevant accounts in order to record the depreciation adjustment. When it comes to buildings, building depreciation account and accumulated building depreciation account. For motor vehicles, motor vehicle depreciation account and accumulated depreciation for motor vehicles. Under machinery, machinery depreciation account and accumulated depreciation account for machinery. For furniture, furniture depreciation account and accumulated depreciation for furniture. Like that, 8 accounts should be opened up. And again, to remind you, these are the necessary values that we are going to included in the profit or loss statement as expenses relevant for the current accounting period. Then from the account we will be transferring this 80,000 as one expense, motor vehicles as another expense, 10,000 as another expense, and 25,000 as another expense. We are not going to add them all together and show it as one figure. Never, never. we are not going to do it like that. We are not getting the total and debiting it in the profit or loss statement. In order to give a clear understanding for the stakeholders of the business, you have to show them under different headings. Buildings comes under administration expense. So under the administration expenses, building depreciation will be debited as 80,000. Motor vehicle depreciation comes under distribution and selling. So that 70,000 has to be debited separately under the heading of distribution expenses. Again, machinery will go under administration expenses and furniture also under administration expenses. So like that separately we are going to show each value of depreciation. Then what will be the accumulated depreciation values at the end of the period? So this table shows the non-current assets again and the accumulated depreciation as at 1st January 2019. Before uh, this accounting period, the previous accounting period, they have been given depreciation like this, and the depreciation for the period we have calculated already will be considered that, and the total amount of depreciation will be calculated by adding the two figures. Up to 1st of January 2019, it's 200,000. Present year or the relevant year, it will be 80,000. Thereby, in the statement of financial position, we are going to show 280,000 as the accumulated depreciation value. When it comes to motor vehicles, accumulated depreciation for previous years are 140,000 plus 70,000 for this year will give you 210,000 accumulated depreciation up to 31st December 2019. Machinery already at the beginning of the period there were 20 which have been for the previous periods plus 10 will give you 30,000 so far. Then again furniture in the same way will give you 75,000. So the non-current assets as at 31st December 2019 will be shown in the statement of financial position as follows. So Nasar's business statement of financial position as at 31st December 2019, non-current assets names you will be given, costs will be shown like this, and the accumulated depreciation will be shown like this, and this is the way we have been calculated that, and that will be coming here, and the carrying amounts will for the at the end of, I mean for the date of, I mean as at 31st December 2019 will be like this. So buildings at the time of purchase the cost will be 800,000. So far they have been uh, depreciated, and the accumulated depreciation with regard to buildings will be 280,000, and the carrying amount or the net book value as at 31st December 2019 will be 520. Motor vehicles are also the same. 700,000 is the cost, 210,000 rupees is the accumulated depreciation so far, and thereby the carrying amounts will be 490. Like that, the difference of the cost and the accumulated depreciation will be given the carrying amounts of all the non-current assets. So thereby, we have to give the total of cost and accumulated depreciation also. You have total and give here, and the carrying amounts. Once you get the total, you will be get coming. You'll be getting a value like this. So when you deduct the accumulated depreciation from each cost, the carrying amounts are coming. So thereby, when the total cost is deducted by the total accumulated depreciation, again you have to get the same answer as carrying amount. I mean the total of these four must be equal to the difference of the two totals of cost and the accumulated depreciation. Thereby, you can double check your figure. So that is the way we are going to show the treatment of depreciation for non-current assets of a business in the statement of financial position. So that will be the last adjustment also, depreciation. Thereby, I hope you all have a very good understanding about the all types of adjustments that we have been discussed so far. With all these adjustments, to mind you, the first one will be the accrued expense adjustment, second one income to be received adjustment, third one bad debts, and the fourth one is depreciation. So thereby, now we have come to the end of all the types of adjustments that we can come across in our examination according to our syllabus. And in my next video, I hope to, and that will be the last video with regard to the financial statements, and I hope to meet you there. And I want to focus your attention of how to prepare the two financial statements with adjustments. So before you watch that video, you better learn the two formats of the two financial statements. And remember, when it comes to the statement of financial position hereafter, there should be 3 columns like this. And at the exam, you will be awarded marks when you have been named these columns appropriately. Not for these calculations or anything. If you have divided this into 3 and if you have named them properly, you will be awarded half a mark. So then again, for these calculations also you will be awarding lot of marks. So then it is your duty to go through the all types of adjustments that you have learned and be ready when it comes to the preparation of financial statements with adjustments in my next video. I hope you all have a very thorough knowledge about the financial statements now, and hope to see you in my next video with a summary of all what we have been learned so far with regard to financial statements, and that's how you will be tested at your examination. Okay, see you then. Thank you very much.